Every month, the US government runs out of money, and somehow finds more. No gold mines appear. No secret treasure gets unearthed. Yet the lights stay on, the checks go out, and the world keeps lending America more. How? Imagine maxing out your credit card, then paying it off with another card, one you printed yourself. That's basically how the United States funds itself. It sounds insane. But here's the crazy part. It works. It works because everyone believes it will. As long as that belief holds, the illusion feels real. And if you want the one-page map of how this illusion was built, drop the word map in the comments. I'll pin it for you. Now let's rewind. Before the year 1913, money meant gold. A dollar wasn't just paper. It was a promise that you could walk into a bank and trade it for real metal. That rule kept governments honest. You couldn't spend what you didn't have. If your vault ran out of gold, your spending stopped. Then came war, World War I. Armies needed guns, ships, and fuel, fast. But America's vault didn't have enough gold to pay for all of it. It's like wanting to buy an entire factory when your wallet only holds lunch money. So the government invented a shortcut: bonds. Elegant pieces of paper that said, "Lend us money now, and we'll pay you back later, with interest." People bought them because they believed in the government's word. But here's where the magic began. In that same year, 1913, the United States created a new player, the Federal Reserve. Think of it as the friend who always says, "Don't worry, I'll cover you." Except they don't use their own money. They type it into existence. When the government needed cash for war, it printed bonds. The Fed bought those bonds with dollars it created out of thin air. The government spent those dollars on weapons, wages, and supplies. And the cycle worked. When the war ended, the habit stayed. America had found its financial caffeine, a way to stretch its power beyond the limits of gold. For decades, the system wobbled between reality and faith. There was still a faint link to gold, a golden leash that kept the dollar somewhat grounded. Until 1971. President Richard Nixon looked at the books and realized the country had printed far more dollars than it had gold to back them. Foreign nations were lining up to trade their paper for metal. If that continued, the vaults would empty, and the illusion would collapse. So Nixon cut the leash. He ended the dollar's convertibility into gold. From that day forward, the US dollar was no longer a receipt for something real. It was the thing itself. You could no longer exchange a $20 bill for gold, only for another $20 bill, backed by faith, not metal. Gold was replaced by belief, and belief has no ceiling. That shift didn't just change money, it changed psychology. The US could now print, borrow, and spend without a fixed limit. As yet, long as people trusted the promise, the system could expand forever. It was like swapping a solid foundation for an elastic one. The structure flexed, but it didn't break. For the first time in history, a nation had found a way to turn faith into fuel. Here's how the trick looks today. The left hand, the US Treasury, writes an IOU. "We'll pay you later," it says, printing a treasury bond. The right hand, the Federal Reserve, buys that IOU, creating fresh dollars to pay for it. Same body, different hands. It's like moving money from your left pocket to your right and telling yourself you just got paid. On paper, it looks clean. Numbers go up. Liquidity increases. Markets breathe easier. But in reality, the government has borrowed from itself. And the illusion works only because the world accepts it. The moment people stop believing the right hand can honor the left hand's promise, the magic fades. For now, though, everyone still plays along. Banks treat treasuries as risk-free. Foreign governments hold them like digital gold. Investors sleep well knowing the Fed will always step in if something shakes. On paper, it looks safe. In reality, it's a mirror trick. And that's how it all began. A century-long habit built on confidence, repetition, and a touch of illusion. From 1913's war bonds to Nixon's leap of faith, the United States mastered the art of borrowing from tomorrow to pay for today. It doesn't feel like magic because we've grown up inside it. But once you step back and see the reflection, the left hand, the right hand, the endless IOUs, you start to realize this isn't just economics, it's theater. And as long as the audience believes the show, the curtain never falls. In 2008, the global financial system was gasping for air. Banks were collapsing, credit froze, and trust, the oxygen of money, disappeared overnight. The Federal Reserve had one move left: print money. But they didn't run the printing presses. They pressed enter. With a few keystrokes, trillions of digital dollars appeared out of nowhere. They called it quantitative easing, or QE. It sounded complicated, but the idea was simple. The government needed money, and the Fed would give it to them by buying their debt. The Treasury printed new IOUs, and the Fed bought them using money it just created. Not earned, not taxed, created. Imagine pouring water into a lake using a hose that's connected to the same lake. It looks like you're refilling it, but in reality, you're just swirling the same water around. That's QE, the bond trick, on steroids. When the Fed started this, it told the public it was a temporary rescue. But like every good drug, it worked too well to quit. It made markets rise, banks breathe, and politicians sigh in relief. Stocks soared, mortgages got cheaper, borrowing felt painless. The world watched America print trillions, and instead of panicking, investors celebrated. Because as long as the Fed promised to buy debt, the price of debt, and everything tied to it, kept climbing. But there was a hidden cost. Easy money never flows evenly. It flows uphill. When the Fed injects new dollars, they don't rain down on everyone equally. The rich, banks, corporations, and funds stand at the top of the hill. They receive the money first before it spreads into the economy. They use it to buy assets, stocks, real estate, commodities. Prices rise. By the time those dollars reach regular people, through wages or stimulus checks, the prices of everything have already gone up. That's why inflation feels like a tax you never voted for. It's invisible, quiet, and cruelly timed. Your grocery bill grows faster than your paycheck. Your rent creeps up, even though your job didn't change. You work harder just to stay in place. That's the Cantillon effect. A centuries-old pattern that says, whoever touches new money first, wins. Everyone else pays later. It's like two people climbing the same hill. One takes the escalator, the other takes the stairs. The escalator rider gets to the top before the slope even steepens, buying everything cheap before prices adjust. The stair climber finally arrives, exhausted, only to find everything already sold or doubled in price. That's how modern finance quietly widens the gap. QE didn't just stabilize markets. It built a wall between the capital rich and the cash poor. The Fed said it was saving the economy, and in a sense it did. But it also saved those who already owned the most. The stock market recovered within months after 2008. Ordinary families took years. Inflation is the quiet tax, the one that never asks your permission. If you've ever wondered why life feels more expensive even when the economy is fine, this is why. It's not your imagination, it's policy. The money trickle-down never reaches the ground evenly. It evaporates on the way. If you want a simple 6-line checklist to protect your money from this system, the same one I use, drop defense in the comments and I'll send it over. Now here's the paradox. The reason this trick works is because the US plays with a deck nobody else has. It prints the currency that the world needs. Every country wants dollars for trade, for savings, for safety. So America can borrow endlessly because the rest of the world keeps lending it back those same dollars. The world sells real goods: oil, cars, chips, coffee. The US sells promises, treasury bonds, IOUs, debt backed by faith. Everyone plays along because those promises are wrapped in the flag of the world's reserve currency. It's the ultimate trade. The world exports sweat and steel. America exports paper and confidence. And that confidence has built an empire stronger than armies. As long as the world needs dollars, the US can fund anything: wars, bailouts, pandemics, simply by issuing new bonds. The world believes in the promise because, so far, it's always been honored. But belief is fragile, and cracks appear when the system gets too heavy. In 2023, several American banks failed, not because they were reckless, but because they trusted too much in safety. They had bought billions in government bonds, the safest assets on earth. But when interest rates rose, those safe bonds suddenly lost value. Their market prices dropped. What was once a rock-solid investment turned into quicksand. It's like buying a 10-year gym membership, only to see the same plan go on sale for half the price a month later. Your deal didn't change, but now it's worth less. That's what happened. Banks were holding long-term bonds paying low interest. When the Fed raised rates to fight inflation, new bonds offered higher yields. Investors didn't want the old ones anymore. The banks tried to sell, took massive losses, and the spiral began. The irony is brutal. The same institution that printed easy money to rescue the system ended up breaking parts of it when it tried to clean up the mess. That's the danger of an economy built on reflexes instead of fundamentals, where every tremor triggers a rescue, and every rescue plants the next crack. QE made the loop stronger, but also more fragile. It stretched the rubber band of faith. And while it hasn't snapped yet, every round of stimulus and relief pulls it tighter. For now, the illusion still holds. The charts still go up. The markets still cheer every new announcement from the Fed. But somewhere underneath, even the believers are starting to wonder, how long can a system keep inflating itself before the hose runs dry? The bond trick didn't just save the US economy, it rewired it. It turned debt into fuel and faith into policy. It made the rich richer, the system dependent, and the future a little more borrowed than before. It's genius, it's madness, and it's working until it doesn't. Every time the Federal Reserve breathes, the world feels it. When it pumps money into the system, liquidity floods every market, stocks rise, currencies strengthen, and investors across the planet feel wealthier. But when the Fed tightens, that same tide retreats. Credit dries up, currencies fall, and suddenly economies on the other side of the world gasp for air. It's invisible, but powerful, like gravity. Dollars move faster than ships, louder than trade deals, and deeper than politics. The United States doesn't just manage its economy, it manages the world's pulse. Here's the simplest way to see it. When America sneezes, the world catches a cold. When the Fed lowers interest rates, money rushes out of the US, chasing higher returns in places like India, Brazil, or Turkey. Their markets boom, their currencies strengthen, and optimism grows. But when the Fed raises rates, that money rushes back home, fast. Those same countries suddenly face crashing currencies, debt crises, and inflation spikes. The same dollar that gave them growth now takes it away. Global money is like a tide. When it rises, everyone floats. When it falls, you find out who's been swimming naked. This isn't conspiracy, it's mechanics. Every major economy holds US dollars for trade, and most global debts are denominated in those same dollars. When the cost of borrowing in dollars changes, it shakes everything from African agriculture to European real estate. The Fed isn't just a central bank, it's the planet's metronome. And yet, the strangest part is how normal it all feels now. We've built a culture around debt, not fear of it, but faith in it. Once upon a time, owing money was shameful. Today, it's a lifestyle. Your credit score is your passport to adulthood. A car, pay monthly, a home, 30 years, a degree, sign here, worry later. Nations do the same, running deficits as casually as you swipe your card. The world learned the American motto, buy now, pay later. We've turned patience into an outdated virtue. Why wait for what you can finance? Why save when the government can print? This mindset is both the symptom and the engine of modern economics. It fuels consumption, drives innovation, and hides risk, for a while. But beneath it all, the same trick repeats. Promise first, pay someday. Debt became the oxygen of our civilization. It's in everything. Homes, education, healthcare, defense. We celebrate those who borrow big and call them visionaries. The billionaire who leverages debt to buy companies is a genius. The worker who does the same for groceries is irresponsible. The system rewards scale, not prudence. And so we all learn to float on promises, assuming the water will never dry up. But what happens when belief wavers? When the tide turns, and people start questioning whether the promises can still be kept. That's the crossroads we live at now, the corner of self-financed debt. The Fed has two doors, and both lead to pain. If it keeps printing and buying bonds, inflation eats away at savings and wages. If it stops, credit tightens, markets fall, and recession follows. It's a loop with no clean exit. The medicine that keeps the patient alive is the same thing slowly breaking his health. That's why every word from the Fed chair moves billions of dollars. When he whispers tightening, stocks dive. When he hints easing, they fly. Faith itself has become a policy tool. We live in an age where belief isn't a spiritual idea. It's an economic instrument. Markets don't trade on gold or oil. They trade on confidence. And confidence, like glass, is beautiful until it cracks. Imagine this. You live in a city built entirely on credit. Every building, every light, every paycheck depends on the next loan getting approved. As long as everyone believes the bank is fine, life goes on. But if one day people begin to doubt, everything stops. That's what self-financed debt really means. You're borrowing trust, and when it runs out, you can't print more. The US stands at that intersection, balancing on the edge of faith and mathematics. And here's the astonishing part. It's still winning. Because America discovered something no empire before it ever mastered. Control through paper, not power. Rome ruled with armies. Britain ruled with colonies. The United States rules with bonds. America doesn't need to conquer nations. It sells them safety, in the form of treasury debt. When foreign countries buy US bonds, they're not just investing. They're funding America's budget, military, and lifestyle. Every dollar they spend comes back as tribute, just wired instead of shipped. Think about it. A country sells its goods, oil, electronics, clothing, to the United States. It earns dollars. But instead of keeping those dollars, it buys US treasuries because they're safe. The US government then uses that same money to pay for imports, subsidies, or bases abroad. The dollars leave America, circle the globe, and return as loans to the very hand that issued them. That's not trade. That's orbit. This is why the dollar isn't just a currency. It's the world's operating system. Every central bank keeps it. Every major trade contract uses it. Every crisis ends with a flight back to it. And as long as that remains true, America can keep doing what no other nation can. Borrow infinitely without breaking. But even empires built on paper need faith to stay standing. And cracks are showing. Countries are starting to ask questions. Why should we keep saving in a system we don't control? Nations like China and Russia are trading more in local currencies or gold. The BRICS bloc talks about alternatives. These movements are small, but they carry a message. Trust can migrate. Still, for now, the quiet empire hums. Its reach doesn't come from soldiers or swords, but spreadsheets. Its borders aren't drawn on maps. They're denominated in dollars. Each new treasury auction, each foreign purchase, each balance sheet update is another silent act of allegiance. And yet, underneath that brilliance lies fragility. Because if belief fades, if the world one day decides that America's paper is no longer worth the promise, the empire doesn't need to be attacked. It simply deflates. For over a century, the US has ruled without conquest, built an empire without colonies, and controlled resources it doesn't own, all because the world agreed to trust its IOUs. That's genius, that's audacious, and it's also dangerous. The global loop is both a marvel and a warning, a system so elegant it sustains itself until the day it doesn't. And when that day comes, when the tide finally pulls away for good, we'll see what's left beneath the surface, who was swimming naked, and who was quietly building a boat. Every headline about the Federal Reserve sounds distant. Interest rates, bond yields, balance sheets. But the truth is, those decisions live in your daily life. When the Fed raises rates, your mortgage payment climbs. When it cuts them, your credit card bill gets cheaper, but groceries creep higher. When it buys government bonds, the stock market cheers. When it stops, your retirement account feels it. The Fed doesn't live in DC. It lives in your rent, your loan, your grocery bill. Every policy they announce is like a change in the wind. Sometimes it's a soft breeze that makes things easier. Jobs rise, markets grow, optimism spreads. Other times it's a cold gust that makes borrowing harder, slows hiring, and cools the economy. Most people don't see the wind. They only feel its effect. They think the weather changed. But it's not weather, it's design. Every gust from the Fed is a choice, and your wallet sits right in the middle of the storm. When the Fed prints money and buys bonds, asset prices rise. Stocks, homes, even used cars. You feel richer on paper, but your dollar quietly loses strength. When the Fed stops and starts selling bonds back to the market, those same assets fall. The wealth evaporates, but the debts remain. It's a cycle that moves faster than most people realize. The people closest to the money, bankers, fund managers, and policymakers, react instantly. Everyone else notices months later, when rent hikes, food prices, or layoffs start landing in the real world. Understanding this isn't about becoming an economist. It's about recognizing that the financial world and your personal world are the same ocean. The tides that lift Wall Street also rock your small boat. And once you understand the rhythm of those tides, you stop panicking at every wave. You start steering. That's why the most valuable thing you can do right now isn't chase headlines or predict crashes. It's build your own playbook. 4 simple rules. Not glamorous, but real. The same rules the quiet rich have followed for generations, while everyone else chased noise. Rule 1. Keep cash that breathes. Don't lock up every dollar. Have a cushion that lets you survive if the market pauses or reverses. Most people think invest everything is smart. It's not. Liquidity is your oxygen. Cash isn't lazy, it's patient. It buys time, and time is what everyone loses first in a crisis. Rule 2. Own what people need, not what they want this year, what they'll always need. Food, energy, housing, information. Essentials survive inflation, recessions, and hype cycles. The wealthiest families in history didn't chase trends. They owned pipelines, farmland, housing, and data. You don't need to own those literally, but you can own pieces of them. The key is to anchor yourself in demand that never dies. Rule 3. Watch policy, not promises. Politicians talk, the Fed acts. If you want to know where markets will move, watch what central banks do, not what leaders say. Look at bond yields, not slogans. Interest rates, not elections. The people who quietly follow those signals always move faster than those who react to the news. Rule 4. Get closer to the source. Every year, make one move that puts you nearer to where decisions are made and money is created. That could mean learning a skill that ties into finance, investing, or trade. It could mean working with people who understand how the system works, or building an asset that benefits from liquidity instead of being crushed by it. The closer you are to the source, the earlier you feel the tremors, and the earlier you can adapt. The secret of enduring wealth isn't luck, it's proximity. Those who stand closer to where money moves don't need to predict the storm. They just adjust their sails first. And here's the truth nobody tells you. You don't have to beat the system. You just have to stop ignoring it. Learn its rhythm, defend your savings, and let compounding do the rest. The system rewards awareness. It punishes distraction. The rules aren't sexy, but they're undefeated. Because behind every flashy crash or boom you see on TV, the same quiet patterns play out. Liquidity expands, wealth shifts upward, and confidence keeps the engine running. When confidence cracks, the system resets. And those who kept cash, owned essentials, watched policy, and stayed close to the source don't just survive, they advance. If you want that checklist, the one-page version of these 4 rules that helps you build your own defense, comment defense below. I'll send it to you. Because the truth is, you can't control the Fed. You can't control markets, but you can control how exposed you are. You can build buffers, buy smarter, and stop letting headlines rent space in your peace of mind. The bond trick may have built the modern world, but your awareness is what keeps it from owning you. Once you understand how the loop touches your life, you stop feeling like a victim of it. You start playing it, quietly, patiently, and on your own terms. Rome clipped its coins. Britain debased its pound. The United States has the bond trick. Different tools, same illusion. Each empire invents a way to stretch faith further than its gold will reach. And for a while, it works. The coins still shine, the notes still spend, the soldiers still march. Until one day, the illusion fades, and what's left is paper, promises, and silence. Every empire believes its money is immortal. Rome thought silver could last forever. Britain thought the pound would always rule the seas. America believes the dollar is untouchable. But money has never been about metal or ink. It's about belief. The moment that belief moves, power moves with it. When the crowd stops clapping, the magician disappears. The bond trick is no different. It runs on confidence, not oil, not labor, not even math. As long as the world trusts America's promise, the machine hums, dollars circulate, debt expands, life goes on. But if trust ever slips, if the world starts asking for something real instead of paper promises, the magic ends. Not with an explosion, but a quiet unraveling. Imagine the day when people stop rolling over those bonds. When nations stop keeping their savings in treasuries. When the tide of faith finally shifts. The system doesn't crash overnight, it just stops breathing. Markets don't explode, they deflate. Quietly, slowly, relentlessly. Every civilization in history has faced that moment. The test of belief. Not when the gold runs out, but when the story does. Because money is, and has always been, a story we agree to tell together. Once that story loses its audience, everything changes. So ask yourself, when belief fades, what will you trust? Paper, metal, or something real? What holds its value when confidence is gone? For some, it's gold. For others, it's land. For a few, it's knowledge, the skill to rebuild no matter what system rises next. That's the hidden lesson behind every collapse and every recovery. The money changes, but the rules of trust never do. Power flows to whoever understands the story first and adapts before the ending. If this video helped you see the system a little clearer, hit like or share it so more people can understand the story behind the numbers. And next up, proximity compounds. 4 ways to move closer to the source of wealth, where the rules are written before the rest of the world reads them. Because the bond trick isn't just about finance, it's about faith and what happens when faith runs out. History doesn't repeat word for word, but it rhymes. Rome had silver, Britain had gold, America has debt. And just like them, its future depends on one fragile, invisible thing: belief. And belief, once cracked, never glues back the same.